Ladies and gentlemen, the members of the acid capitalist tribe. It is Friday. I don't know. Is it a 17 hand or an 18 hand? Heavens, my mum's birthday. I'm very excited. It's really early in the morning. I haven't had breakfast, and we're on the World Wide Web, and we're stretching all the way over into Asia to bring not just anyone. Not just anyone. We could get anyone on the show, but I have the great pleasure. I'm quaking. I'm going to speak to a really, really smart person who takes risk, who seeks, searches, can smell it. The sweet smell of risk in the morning coming out of Asia. Without further ado, I have the incredible David Dredge, a legend, a Convexity maven, macro, you name it. This guy is, and don't worry, you're like, what is Convexity? We'll get there. But first and foremost, Dave, welcome to the show.
Thanks, Hugh. It's great to see you. Great to finally see you face to face.
Yeah. Well, I went blonde again yesterday, so I'm just keeping the hat on just now. It takes a few days to settle in. I'm looking a bit like Eminem. I might rap towards the end of the show. And of course, welcome to all you guys and girls in the cheap seats. You've got less than 30 minutes. I wish you'd subscribe to the Patreon. If you take on the Patreon, you get like years of the back catalogue with like some really dope interviews. You get to watch all of this. I mean, what you're going to miss after 30 minutes is going to be insane. And if you pay the top one, we've got a John Galt membership. You actually get Zoom calls one-on-one with me. So what are you waiting for? Anyway, let's get over to, I mean, talk to me. But you don't need any introduction, but just give it, like, for the folks listening in, maybe for the first time, just give them the key ingredient, Dave, would you?
As you said, his esteemed listeners, I'm sitting over here in Singapore. I've been in Asia off or on for most of my professional life. I run a small business out here that we call Convex Strategies. It's a Singapore-based investment manager. And we're in the business of hedging and convexity and creating highly asymmetric convex portfolios to help people improve the long-term investment strategies and improve people's retirement so they have compounded terminal capital at the end. And I've been doing it a long time. I came out here in time, I said to Hugh earlier, just in time to catch the 1987 stock market crash. I was back then with Bank of America. I spent most of my career building and running the emerging markets, trading and derivative businesses for Bankers Trust out here in the 90s. Did some more of the same with ABN AMRO and RBS, but have been in the long volatility hedge fund business since 2000 and into 2008. Worked with some guys at Artratis that you may know, Hugh, Steve Diggle, and Richard McGinnis. And our current setup has been running for about 12 years now.
12 years, yeah. I mean, we might have to get you a wig, really, because I think of you like Samson, and you're holding the whole artifice of the clients. You're like, they're all short vol, and you're like, oh, okay, I got you guys. Like, I got you. 12 years. So, what three big ones like for you in terms of where you really came through and kind of held the fort,
in a sense, more than that, because really the concept of what we do, was the core of what I came up with when I pitched. I originally came out with Bank of America in 87 and ended up sort of being the guy that went around to their local branches and set up the trading and treasury businesses in the EM countries when they all started deregulating in the late 80s. And it dawned on me then, I'd come straight out of graduate school at Berkeley, where I went to grad school and studied economics with Professor Yellen and financial derivatives with a guy named Mark Rubenstein in 1987, who was running a portfolio insurance business. So you could say I'm actually doing what I went to school to do all these years later. But the concept, it dawned on me, having been educated at sort of, the peak of that world at the time, that what people thought was risk or how people looked at risk in developed, what I might have called efficient markets back in those days, wasn't really applicable when you got into the complexity of emerging markets. And you could see in all those markets and the businesses that the banks were running in them, it had that dynamic, and I'm sure you've seen this a million times over, of make a little, lose a lot. Make a little, lose a lot. And, the concept of using historical volatility and correlation as a measure of risk in places where markets weren't free to determine the price of risk. They're pegged currencies and limited onshore-offshore access and preferential treatment and no foreign borrowers of stock markets, et cetera. And so you ended up having these correlation shocks and explosions where everything you thought wasn't correlated suddenly became correlated. So I came up with this sort of concept, if you will, of embedding long convexity to build out, as we build out the market making and derivative structuring and underwriting businesses in places. In 1991, there weren't a lot of option markets in Taiwan and Korea and Indonesia and Thailand and Philippines and Vietnam and et cetera. So we came up with the concept, and it's become bread and butter of the volatility world around the globe, of embedding short volatility in yield enhanced structured products to feed the repressed financial system savings pool of Asia. Japan, first and foremost, sort of the grandmother of all structured product yield chasing markets, but increasingly Taiwan, Korea, pension funds, insurance companies, banks, private wealth managers, until over time the world caught on, and that savings pool and financial repression in Asia has made, targeting investment clients with yield enhanced products the core of the investment banking business in Asia. Not surprisingly, now we just sit in my post banking days and my retirement activity. We sit here in that food chain and capture vol.
Can we make a distinction there? Sorry, that you're talking about then versus now, and when you were with the bank, you were selling yield enhancement products. You're not doing that now.
No. So
just so that people can understand that. It was there, but really accelerated with the quantitative easing of Japan, but really. So quantitative easing came after the ZERP of the zero interest rates. And then I think what you're alluding to is that over time, volatility became a source of yield enhancement.
Correct.
Again, you're long volatility,
yeah.
And people discovered that they could sell volatility
Correct.
and accrue and actually get a yield to add on to the zero that they were getting from corporate and risky instruments.
Correct.
So yield enhancement has kind of, if you will, and its predominance is almost like we've sprinkled gasoline all over the Japanese igloo, because the temperature's still, I know it's getting a little bit modestly warm, but we put gasoline all over the igloo, and that is this yield enhancement. And again, for the people in the seats at home, so traditionally you own risk assets. And so you are effectively short volatility in the nomenclature. And when unexpected events happen, your short position gets squeezed and you lose money. The volatility surges periodically, but it can be profound in the movement.
Mm-hmm.
And you, the other side, you're providing a risk layover for those events.
Correct.
Okay. So there's no yield that you can offer now, and indeed your strategies actually, they've kind of got to pay you almost like an insurance premium to have that facility.
Yeah, so I pay a cost. So if you think about it, a great way to think about it. Yeah,
you pay a cost on behalf of your clients.
Yeah, a good way to think about it. Most investment businesses are in the business of owning assets, right? They've foregone liquidity in search of a return. I'm in the business of owning liabilities. I've stored liquidity at some cost. Now, I do that in highly convex form because I'm doing it through volatility and convexity that I'm able to isolate and capture in the global volatility markets. Now we manage volatility books all over the world in every asset class. We just happen to sit in Asia because the biggest providers, the sellers of those volatilities, the end sellers, are the large saving pools in Asia. Institutions in Taiwanese insurance companies, Japanese banks, Korean pension funds, Singapore and Hong Kong private banking accounts, and it's
again,
going
Dave,
on.
there's no cultural bias that explains the predominance of it being Asian. But so what is it's not cultural? Why is it not European? Why is it not American? Is it just that Japan went first into the kind of zero bound?
Yeah, so in a sense, it's the global balance sheet. So you go back to the early 90s, Asia in essence is the global savings pool, and the West is the global deficit. So Asia is the surplus, the West is deficit. And Asia much earlier on, most explicitly Japan, but everybody else who had pegged their currencies to the dollar a long time ago have been active financial repressors for 30 plus years. And so you've had negative real rates out here, going back into the early 90s across the entire region where everybody had tied their currency to the dollar, but were running much higher growth, much higher inflation environments. And that has just persisted. And so the evolution of this yield seeking derivative structure food chain is 30 plus years old here and really only came into fruition in Europe and the US post QE in 2009, where interest rates went to zero. But the negative real rates out here are much more persistent and much longer in history. And if you think about it, what is QE? QE, everyone's familiar now with QE.
What is QE? What is QE?
So QE, when we think of QE in the US, it's the central bank buying US treasuries. Now in Asia, central banks have been buying US treasuries for a very, very long time. But out here, they and the IMF call it building up reserves, FX reserves. But building those massive FX reserves that were all part and parcel of their mercantilist currency policies is really just QE.
Is the key word. I mean, they are, I think, multiples, and I'm thinking like 10x, 20x, 30x beyond any IMF prescribed prudent level of reserves. And actually, and I have to thank you because just as you were speaking, I was getting light bulbs. Yeah, that's why these liquidity pools, of course, are so gigantic in Asia.
Yeah.
30 years ago was the end of economic history. It was the end of macro history. It was the switch coming from a newly emerging industrializing nation that was going to fund its industrialization domestically. South Korea had done it running deficits and the rest of the world, and it had an abundance of locally sourced investment projects with huge NPVs, just didn't have the savings, and you ran a trade deficit, and that was the conduit for the surplus savings in the rest of the world to come into South Korea. That was rejected by the Chinese post the Asian tiger crisis. They said, we're going to do it. We're going to finance it domestically. We're going to peg against the dollar, and effectively going to redistribute income from the household sector back into the core. And part of that redistribution or wealth capture is this confiscation of wealth via negative interest rates in the banking sector. So,
correct.
Boom, you got it. That's why it's Asian.
Yeah.
It's really the end of history with regard to the rise. I mean, 30 years ago, China was less than the GDP of Turkey.
Yeah,
today it's the size of Europe. Okay, that explains this pool, this monstrous pool. Now, for the folks again, because we're a wide church, give them convexity. Like if you were Peter Lynch and the yellow note where you had to be able to write it down on the Scotch note. Give me the Scotch note. Where is it? Convexity.
I'll give you a simple analogy, right? We use this all the time in what we do. Convexity is acceleration and deceleration. So the most people think of the world as linear, but it is not. It's nonlinear. Most investment portfolios are concave, not convex. They're slowing down in good markets and speeding up in bad markets. They've got bad correlation. Convexity is the race car, the Formula One race car in a 40 circuit race, the guy who wins that race is the guy with the best brakes. All right. And he wins the race because he can drive faster than everybody else because he has the best brakes. And so in the best part of the racetrack, he can accelerate. So think about it in financial markets. When the market's going up, you're going up faster. And in the most dangerous part of the racetrack, the unforeseen, unexpected curve that suddenly materializes, you can slow down the fastest. And so think about that in the terms of stock market, the stock market that's the market that's going down, the asset portfolio that's going down. You have brakes so you can decelerate the decline. And that convexity is that ability increasing on the top side, decreasing on the downside. So in my old math classes, it was a curve that would hold water, whereas the concave one was one that would spill water. And that's the way we learned it back when I was a kid.
I'm reaching for my checkbook. I mean, I've got a sense of if I had capital, I'd be coming over there. And people, this is kind of what I try to do. I mean, and again, there are not many areas of expertise. You've got Spitznagel, yourself. I mean, I tried it, but I had the wrong. I should have been saying that, and instead, I was saying to clients, "I dare you to give me money." I think your strategy is a lot wiser. Anyway, so I've been saying to the world this week. I mean, we investing and living and breathing is all about forming prejudice. Incoming data, and it comes through this filter, which is the number of years you've lived on this planet and the things that have happened to you. And I have a sense of dread, really, about the forces which I see, and a lot of it are kind of silent. The Fed and a lot of people, understandably, look at stock markets, and if they look at any economic data, it's the employment. They don't look at money, and they don't look for the presence of these mysterious forces. And our universe is mysterious. It's like you don't see the wind, but if you see the trees behind me, they're moving, and it's indicating that there's a phenomenon out there. And depending on how much there's movement, then you get a sense of just how much the presence is there. So I'm sensing a big disturbance in the force. Anyway, but on a par with 2008, and we were saying, the frustration that I have is back then, from about 2006 or so, there were strategies that could aid and assist your braking in markets, and there was definitely a feeling amongst the wiser heads that good brakes were going to be necessary somewhere between 2007 and 2009. And boy, were there products available. And I've just been lamenting that it's one thing to call central banks goofballs. I mean, I think well-intentioned. And I'm not a conspiracist. I believe life is all about the law of unintended consequences. They don't do it in an evil manner. They just do it because, it's complicated. But try as I may, I can't find a great deal of let's use this word, the accelerant for me in terms of if there's going to be a short score, but that's your bread and butter. So, and you've got a team, and you're not necessarily setting out with that. That's me. I'm prejudicial. I think you explicitly say that you go into the office every day without prejudice. Yeah. You're simply, if I may, I use a lot of metaphors with regard to Amazon and their logistics and their wonderful warehouses. And I think of you as being this, I think of you like calling down like, hey, can you guys go to, line or bay 15 on the top left-hand side? There's a parcel there. Bring it up to the front. We're ready for it. Yeah. Like you're the procurement officer, and you're seeking. You have to identify all the lowly rated risk, the risk which is priced in a manner which makes it intriguing. And so I guess you must have filters, but really, could you expand upon that? Because that's what I've got to go looking.
Yeah, people, my friends in the long vol world, most of which I know, a decent chunk of the vol world spends their time, I almost said waste their time, but spends their time focused on S&P, Vol, and VIX. And whenever they run into me, they're always very excited to find out what I'm doing, because I tend to do stuff that most of them have never imagined even existed. And they say, how do you find this stuff, Day? And I say, well, I sit in Asia, and I put a sign on the door that says, I buy Vol. And I just sit and wait for the queue to show up, right? And everyone who can't find anyone else to buy it, when supply and demand gets out of balance in places where ginormous, if the biggest exporters in one of the world's biggest exporting countries are all enhancing the yield on their excess surplus cash balances in a financially repressed world by buying products that embed highly levered short dollar options against their future export proceeds. And they do this in scale and scale and scale, because nobody in the food chain has to account for the hidden tail risk of that in the way the financial system looks at it, or the way regulators look at it. Eventually, the supply will dwarf the demand. And think about it, Hugh, the entire world in this vol selling levered carry dynamic is accounting for that enhanced yield or that short option premium as revenue, calendar year revenue, paying everybody bonuses on it, and not accounting using something like value at risk and 2 standard deviations to completely not recognize the tail risk on something that has infinite potential loss. And meanwhile, my investors have to account for the cost of storing that liquidity in its convex form, the option premium or whatever I'm paying. And nobody gets the look through to the risk, the tail protection they're getting. And so inevitably, in a world that, as I say all the time, the biggest flaw in the financial industry is nobody's figured out how to create an incentive around geometric compounding. The entire incentive of the system is annual arithmetic returns. And so in that world, and with the accounting and risk requirements, inevitably supply and demand in these types of things, where the largest player in a market dwarfs everybody else, and eventually, the system, the derivative structuring, derivative exotic managing banks have so much volatility that they want to throw it away. And the last,
so forgive me, I get that. That's the constant. That never goes away. There's just occasionally flares. So convex products are by and large lowly rated and available. I mean, I say that, but one of the questions when you were describing that is, you do have to pay, and on average, on any one average year, how much do you think? I mean, I'm guessing you've got clients for risk buckets and therefore budgets. What is the typical budget in terms of an annual cost for having that protection? Is that a good way of thinking about it?
Yeah, again, it comes down to any client, what they're trying to do and what their risk appetite is. So you can show me any investment portfolio. So call it 60-40, right? Let's take a generic 60-40 portfolio. And if an investor is happy with the risk of 60-40, I can show them an equivalent risk replacing the dead capital, what I would call the 40, the non-participating, the non-accelerating, and the non-decelerating, right? Replace that with explicit breaks, so you can go and put more acceleration, more participation in, because of the efficiency of the explicit breaks, the convex hedge. Yep. It cuts off the risk, so you can take more risk. And this is Spitznagel will say every time you ever hear him speak, good risk mitigation means you can take more risk. The 60-40 model, the whole sort of Kelly criterion in the industry, they think risk management is driving slower, right? They say reduce the risk by taking 40% of the capacity out of the engine, use a short-term look-back probabilistic frequency of curves, and bet that you can drive at 60% speed and probably not crash. And then everybody measures themselves based on average lap speed, 1 lap at a time, and ignore the compounding of the ability to accelerate in the straightaway and slam your brakes on and cut the corner, come out the other side. And so by eliminating
But you're not saying take the 40% out, because the 40% would be supposedly the diversifier to the what they regard the principal component risk analysis is the equity. And they say, well, let's have the bonds. You're not saying take the bonds out. You're just saying, hey, look, or you are saying take them out.
Get rid of them. Okay, they're useless. Right? They neither participate nor protect. Now, sure, when bonds had yield, when bonds themselves had positive convexity because of their relationship to yield, looked okay. But it's been a long time since bonds had yield. And bonds without yield.
Let's have a bit of yield now. I mean, like 4% yield on the 10-year.
Negative real yield is not going to compound over a long time horizon. So bonds, again, don't get me wrong, there are times when bonds are probably a good trade. And if your job is to trade bonds, great. But if your job is to compound capital over multi-decades, 3 or 4% yielding bonds in a 5 to 8% inflation environment isn't going to help someone's retirement. Right now, it might be a good trading opportunity in a short time period.
You're going to get rid of the bonds, and you're going to take the equity. You're going to say, "Hey, look, what is your specialism? Is it? Let's say it's equity. It may be something else, but let's say it's equity in this 60-40 model. Let's take your Let's stop driving at 60%. Let's take your equity model, your allocation higher. Yeah. And then pay me or pay for a strategy. Okay, so are you going to go to, again, there's no precise answer, but say you went to 100, right? Would you then say, look, you've got to give away 5% a year?
Yeah. So my simple example that I use all the time in my writing is just a generic example of walking through it, right? So start with your 60-40, take the 40, split it 50-50 between long volatility and more equities. So you're now 80-20. Now, because of the efficiency of that and the cost efficiency of the 20, 2x it. And because of the efficiency of the margin requirement and owning optionality, that's easy to do, right? You don't need the full AUM. And so you now have 80-40, and that's so much less risky than the 60-40 was because of the efficiency of the long vol. And that, I will come back to it. So take some of the 80 and put something in more juiced upside. So put 40 in.
And this is the last interrupt. I mean, the movement board options. But the people in the cheap seats have got to, you're going to leave. Like, you're going to leave. Like, whereas the Patreon members, me and Dave, I just wish you could stay. But anyway, thank you. I hope you enjoyed this modest session live from St. Bart's. Look, the big reveal, look, blonde hair. Look, okay, it's away again. Anyway, good.